Hi, I'm Trevor Owsen, founder of Authentic Life Financial Planning. In this video, we're covering what you need to know about the 83B election. Now, the 83B election, again, only applies to restricted stock awards. I want to make that very clear. It only applies to restricted stock awards. It's not eligible for restricted stock units. But if you do have restricted stock awards, you can choose to file an 83B election. Essentially what that does is instead of waiting until when the shares vest, you can choose to have the shares be taxed when the shares are granted to you. Now, the question may be like, well, why the heck would I do that? Like, I'm not getting any value at that point. I'm not sure if I'm even going to be at the company long enough to have any value from it. Again, these are restricted stock awards, so they're generally pre-IPO and earlier pre-IPO companies, not late stage companies where an exit plan is likely in the works. Maybe years before any actual value comes from the award, which is a great question and very fair question. And so the reason why you might is because if you expect to stay there long enough, and if you expect if you expect the value of the company to grow quickly, then it can make sense to do this. Now, again, it's not a for sure thing. You have to kind of hope that it's going to work out the way you're wanting it to. But if you do that, you may be able to save a fair amount of tax. So essentially what happens when you file an 83B election is that you're choosing to be taxed at grant rather than at vest. And if you do that when the shares are hopefully valued lower than when they could be at vest, it can allow you to save a fair amount of tax on the difference between what the value is when they're granted versus what the value is when they vest. The second benefit to that is that it allows you to start the long-term capital gain holding period, which is actually kind of a cool benefit. Again, paired with being able to get taxed on a lower amount. Again, that's going to be taxed as compensation income, so Fed, state, local, FICA taxes may all apply. If you do that now when it's a lower value versus waiting to when it vests, there may be some like tax arbitrage that you can have if the company grows substantially. Now, it would have to grow pretty substantially for this to work. Anywhere from 2 to 4 to 5x at least, I would say, is like when it really could make sense. And then again, you have to expect or hope that you're going to be at the company long enough to, be there for the shares to actually vest. And if you do, when the shares vest, essentially nothing happens from a tax perspective. You've already been taxed on the shares. You do ultimately take ownership of the shares at that point. So the shares are yours. And so when a liquidity event happens, the growth, between the value at grant and the value at sale will be taxed as a long-term capital gain, which again could be a really good value if you wait. If the company does well and has grown enough, there may be a lot of value in doing that. Now it's all hypothetical. Again, it depends on your situation, depends on your belief in your company, depends on your belief in staying at your company long term. But it certainly is an interesting option for people who have been granted restricted stock awards. Thanks for watching. If you found this video helpful, please like, subscribe, and drop a comment below with any questions or topics that you would like to see covered. Financial planning is all about creating the life you want. Let's build it together.